Everyone was watching the price. Almost nobody watched the flow. That was the mistake. Bitcoin just reclaimed $65,000, but that's not the real story. Underneath the price, spot Bitcoin ETFs just flipped to a massive $1.3 billion inflow. After weeks of relentless outflows, institutional money just came rushing back in. That is one of the sharpest reversals in demand we've seen all summer. And it's happening in the exact same week Congress takes up the Clarity Act. A make or break Senate vote on crypto regulation is now days away. So the price reclaiming 65,000 is just the tip of the iceberg. The real story is what the biggest players are doing right now, quietly. In this video, we break down the flow flip, the whales, and the levels that matter. Stick to the end, the last third holds the real edge nobody's talking about. Let's set the scene properly, because the number on the screen only makes sense when you understand what it took to get here. As of right now, Bitcoin is trading right around $64,600 to $65,000, up roughly 4% in the last day. Now, 4% on its own doesn't sound earth-shattering, but rewind just 48 hours. Bitcoin was getting flushed down towards $62,000 in a violent leg lower that liquidated hundreds of millions of dollars in leveraged long positions. Sentiment was in the fear zone. The headlines were all about the Fed turning hawkish, about Michael Saylor's strategy pausing its Bitcoin buying, about ETFs bleeding money week after week. It genuinely felt to a lot of people like the start of a deeper breakdown. And then the market did what it so often does at the exact moment of maximum pessimism. It reversed. Hard. Bitcoin snapped back up, reclaimed 64,000, then pushed through and held above 65,000. But here's the part that matters most, the part almost nobody is emphasizing. The price reclaim is not the real story. The real story is what happened underneath it. Because while everyone was staring at the candles, the flow flipped. Spot Bitcoin ETFs, which had been bleeding money for weeks, including a record-setting $4.5 billion outflow in June and continued net outflows into early July, just recorded a massive $1.32 billion net inflow. Let me say that again so it lands. After weeks of institutional money walking out the door, over $1.3 billion just came rushing back in. That is one of the sharpest single-shift reversals in institutional demand we've seen all summer. And this is the kind of signal that most retail traders completely miss, because they're glued to the price ticker instead of the money flows underneath it. So in this video, we're going to break down exactly why that flow flip matters so much, what the whales are doing, what's happening in Washington with the Clarity Act, and the precise technical levels that decide whether this reclaim turns into a real trend or fades into another fake-out. But first, let's make sure we're all speaking the same language, because the power of this story lives in the mechanics. Let's start with that word that dominated the headlines 2 days ago: liquidation. A liquidation happens when a trader borrows money, uses leverage, to make a bigger bet on price than their own capital would allow. If the market moves against them far enough, the exchange forcibly closes their position to stop further losses. When you have hundreds of millions of dollars in leveraged longs all stacked up and price starts falling, those positions get liquidated one after another. Each forced sell pushes price lower, which triggers the next liquidation, which pushes it lower still. It's a domino effect, a cascade. That's exactly what drove the flush towards 62,000. And here's the crucial insight. That was not long-term holders deciding Bitcoin was doomed and dumping their coins. That was over-leveraged short-term traders getting mechanically, forcibly washed out of the system. That distinction is everything, because mechanical force selling and genuine conviction selling look identical on a red candle, but mean the complete opposite for what comes next. And this is why the flush actually set up the bounce. When a market gets cleared of its excess leverage, it becomes healthier, not weaker. All those traders betting with borrowed money they couldn't really afford, they're gone now, washed out. And when they're gone, there's far less fuel left for another downward cascade because there are fewer forced sellers left to trigger. That's precisely why, again and again in Bitcoin's history, the sharpest recoveries come immediately after the most brutal liquidation events. The flush clears the deck, and then the market, lighter, cleaner, and with the weak hands removed, is free to reverse. That mechanical reset is a big part of what made this rally back above 65,000 possible in the first place. Now let's talk about the flow flip in real depth, because this is the centerpiece of today's story. Spot Bitcoin ETFs are one of the clearest windows we have into what big, traditional, institutional money is actually doing. When money flows into these funds, it means institutions and larger investors are buying Bitcoin through a regulated familiar wrapper. When money flows out, it means they're selling or reducing exposure. For most of June and into early July, the flow was decisively out. June saw that record $4.5 billion outflow. There were multi-week stretches of consistent withdrawals. Some analysts even started describing it as a potential structural break in institutional demand, suggesting the big money was losing faith. That was the bearish narrative, and it had real teeth. But narratives built on a single direction of flow are fragile because flows can turn on a dime when sentiment or catalysts shift. And that's exactly what just happened. That $1.32 billion inflow doesn't just stop the bleeding, it reverses it. It tells you that the same institutions who were stepping back are now, at least in this window, stepping back in. And when institutional buying returns at the same time whales are accumulating, you get a powerful combination of demand hitting a market that just cleared out its weak leveraged longs. That brings us to the whales because the on-chain story here reinforces everything the ETF flows are telling us. While price was dropping toward 62,000, while liquidations were cascading, while retail was capitulating, the whales, the wallets holding between 1,000 and 100,000 Bitcoin, were not scared. They were accumulating. On-chain data showed large holders pulling coins off exchanges and moving them into cold storage during the exact window that retail was panic selling. There were reports of single whales moving thousands of Bitcoin. One moved nearly 3,000 BTC worth around $188 million to a new address in mid-July alone. And this fits a much larger pattern that's been building for months. Whale wallets have accumulated on the order of 270,000 Bitcoin over a 30-day window, worth roughly $16.5 billion at current prices. One of the largest whale accumulation waves in years, so piece the timeline together. Through June and early July, ETFs were bleeding while whales were accumulating. Retail saw the ETF outflows and the falling price and panicked. And now in July, the ETF flow has flipped positive. The whales are still holding what they accumulated. Price has reclaimed $65,000, and the people who sold into that fear are watching from the sidelines. Now, why does it matter so much whether Bitcoin sits on an exchange versus locked in cold storage? Let me break this down clearly. When Bitcoin sits on an exchange, it's liquid, bistre, ready to be sold at a moment's notice. High exchange balances generally mean more potential selling pressure. The coins are loaded in the chamber, ready to fire. But when Bitcoin moves off an exchange into cold storage, a private, self-custodied offline wallet, it signals the holder isn't planning to sell anytime soon. They're taking their coins off the market, out of circulation, locking them away for the long haul. So whales pulling Bitcoin off exchanges during a dip is not the behavior of someone who thinks price is about to collapse. It's the behavior of someone who thinks price is cheap and wants to accumulate. It's the on-chain equivalent of quietly buying up all the discounted inventory while everyone else sprints for the exits. And this leads us straight to one of the most important concepts in all of crypto. The concept the last few days illustrated in real time. It's the transfer of coins from weak hands to strong hands. Weak hands are the traders who fold under pressure, who can't stomach volatility, who buy near the top when it feels euphoric and sell near the bottom when it feels terrifying. Strong hands are the holders who accumulate through the fear, who see a dip as opportunity rather than threat, who have the conviction and the capital to hold through the pain. What we just witnessed, retail capitulating at 62,000 while whales accumulated and institutions prepared to flip their flows positive, followed immediately by a reclaim of $65,000, is a textbook, real-time example of a transfer from weak hands to strong hands. Coins moved from the panicked to the patient, from retail to whales, from exchanges to cold storage, and the people who sold got to watch within days, as the very bottom they sold at became the launch pad. Let me reinforce this with sentiment. Heading into this bottom, the Crypto Fear and Greed Index, which measures market emotion on a scale from 0, extreme fear, to 100, extreme greed, was sitting deep in the fear zone, down around 20. And here's the contrarian lesson that separates professionals from amateurs. Extreme fear is historically one of the best buying opportunities in Bitcoin's entire history. Think about the logic. When is Bitcoin cheapest? When everyone is terrified? When is it most expensive? When everyone is euphoric and greedy? The index pinned in fear meant the crowd was scared, sentiment was washed out, and the bulk of the weak selling had likely already happened. Warren Buffett's famous line fits perfectly. Be fearful when others are greedy, and greedy when others are fearful. When others were fearful, the whales and now the ETFs were being greedy, and the market rewarded them. That's the pattern, it repeats. Internalize it, and you stop seeing these moments as things to fear and start seeing them as things to prepare for. Now here's the factor that makes this particular moment genuinely different from a routine bounce. What's happening in Washington? This week has been designated Crypto Week in the House, and the centerpiece is the Clarity Act, a major piece of legislation aimed at establishing a clear regulatory framework for digital assets, defining which agency oversees what and giving the industry the rules it's been begging for. The bill has cleared key hurdles and is heading toward a make-or-break moment in the Senate with a real deadline pressure. It has a limited number of Senate working days before the August recess to advance. Why does this matter so much for Bitcoin? Because for years, one of the single biggest overhangs on Bitcoin and the entire crypto industry has been regulatory uncertainty. Businesses didn't know the rules. Institutions were cautious because they feared enforcement actions or sudden reclassifications. Clear, favorable regulation removes that uncertainty and gives institutions the confidence to allocate serious capital knowing the rules of the game. And it may not be a coincidence that ETF flows just flipped positive in the very same window that regulatory clarity is moving forward. Institutions front-run certainty. So watch the Clarity Act's progress extremely closely, because the market's reaction to whatever happens, whether it advances, stalls, or gets amended, could be one of the biggest catalysts of the next few weeks in either direction. Okay, let's put on our technical hats now and get into the actual chart, because this is where all this narrative becomes a concrete, actionable plan. Levels matter, structure matters. Let's walk through it. The single most important level in the entire Bitcoin market right now remains the 200-week moving average. This is the average price of Bitcoin over the last 200 weeks. Roughly 4 years of price data smoothed into one line. Why is it so critical? Because historically, the 200-week moving average has acted as the ultimate bull market floor. In previous cycles, Bitcoin has only briefly dipped below it during the deepest, darkest moments of bear markets, and those turned out to be generational buying opportunities. As long as Bitcoin holds above this line, the long-term bull structure remains technically intact. That line sits down in the low $62,000 region, which means the flush to $62,000 was a direct test of it, and the market held and reversed hard. That's technically significant. The ultimate long-term floor was tested under maximum fear, and it held. Bulls could not ask for a much cleaner defense of the most important line on the chart, and now price is trading comfortably above it again. Now let's map the specific support levels, the zones where buyers are likely to step in and defend. The first immediate support now sits in the 63,000 to 64,000 region. This is the level Bitcoin just reclaimed, and holding above it keeps the bullish structure intact. Below that, the next crucial demand zone is 60,000 to 62,000, which overlaps with the 200-week moving average and the recent lows that just got so decisively defended. As long as Bitcoin holds above this broader zone, the reversal thesis stays alive. Below 60,000, we'd be looking at a deeper demand region around 58,000 to 58,500, which has historically attracted real buying interest. And in a genuine worst case, the final floor sits down in the mid-50,000s. Let me be crystal clear. I am not predicting we go back there. The last few days strongly suggest the opposite. But I map the terrain so that no matter what happens, you have a plan and you're never caught off guard. The bullish thesis would only truly be invalidated by a sustained, decisive weekly close well below the mid-50,000 region. Now the resistance levels, the zones where sellers are likely to appear and slow a rally. The first immediate hurdle is right around $66,000, a level that has repeatedly acted as a ceiling in recent weeks. Bitcoin has broken up through the 63,000 resistance, which is bullish, but 66,000 is the next real test. Bulls need to push through and, crucially, close above it on higher time frames to prove the momentum is genuine and not just a short squeeze spike. Clearing 66,000 with conviction would open the door toward the upper 60s. Beyond that, the bigger picture resistance clusters up in the 70,000 to 72,500 region, where a cluster of major moving averages sits. Reclaiming that zone would essentially confirm the correction is over and the next real leg up is underway. So the upside roadmap is clear. Hold above 63 to 64, break 66, then challenge the 70 to 72,000 cluster. Each level reclaimed is a step toward full confirmation. Let me touch on the RSI, the Relative Strength Index, because it's one of the most useful momentum tools, and I want you to understand what it's telling us. The RSI measures whether an asset is overbought or oversold on a scale of 0 to 100. Above 70 is generally overbought, meaning a move may be overextended and due for a pullback. Below 30 is oversold, meaning selling may be overdone and a bounce could be coming. Into the flush, the RSI had dropped toward oversold, which combined with the extreme fear reading was a classic reversal setup, and it played out exactly as textbook contrarians would expect. Now, after this sharp rally back above 65,000, the RSI has snapped up toward more neutral territory. What we want to watch from here is whether it can climb toward the higher end without immediately becoming overbought. A healthy, sustainable uptrend climbs steadily, whereas a violent spike straight into overbought territory often signals a move that's stretched and vulnerable to a pullback. So keep an eye on the RSI over the coming days as a gauge of whether this rally has real legs or needs to cool off and consolidate first. Now let's zoom all the way out and synthesize everything, because this ties it together and gives you the real takeaway. Here's what we know. On the bearish side of the ledger, the Fed remains hawkish and macro liquidity is still relatively tight. June's ETF outflows were record-breaking, and the recovery in flows needs to prove it's sustained, not a one-off. Part of this bounce is likely short squeeze driven and must hold its gains. And strategy has paused its reliable buying. On the bullish side, whales have aggressively accumulated around 270,000 Bitcoin worth roughly $16.5 billion and are holding it in cold storage. Sentiment was pinned in extreme fear, a historically powerful contrarian buy signal. The brutal liquidation flush cleared out over-leveraged longs and reset the market. The 200-week moving average, or the most reliable long-term floor in Bitcoin's history, was tested and decisively held. Bitcoin reclaimed 65,000 and broke 63,000 resistance. ETF flows just flipped to a massive $1.32 billion inflow. And the Clarity Act is advancing through Congress during Crypto Week, offering a genuine regulatory tailwind. When you weigh both sides honestly, the balance of evidence has tilted meaningfully toward the bulls over the last few days. That doesn't mean it's straight up from here with no pullbacks. It never is. But the confluence of whale accumulation, extreme fear, a held major support, a sharp reversal, a flip in institutional flows, and a regulatory tailwind is exactly the kind of combination that has historically marked important local bottoms. So let me give you 3 concrete scenarios, so you're prepared for whatever actually unfolds rather than betting everything on one prediction. Because the traders who survive and thrive plan for multiple outcomes, they don't fall in love with a single guess. Scenario 1, the bullish continuation. In this scenario, the reversal is real and the flow flip is the start of a trend. Bitcoin holds above the 63 to 64,000 support, whale accumulation proves prescient, ETF inflows continue rather than reversing back to outflows, and the Clarity Act advances favorably, delivering the regulatory clarity institutions crave. Bitcoin pushes through 66,000 and starts working toward the 70 to 72,000 cluster. In this scenario, the 62,000 flush becomes the exact bottom that everyone who panic sold will wish they'd bought instead. Signals to watch for confirmation: strong daily and weekly closes above 66,000, ETF inflows continuing across multiple days, favorable movement on the Clarity Act and the Fear and Greed Index climbing out of the fear zone toward neutral or greed. Scenario 2, the consolidation and chop. In this scenario, the bounce holds but doesn't immediately rocket. Bitcoin gets stuck in a choppy, frustrating range roughly between 62,000 and 66,000 for a while, digesting the macro uncertainty, waiting on the Fed and on the Clarity Act outcome, and slowly building a base. This is a very common and healthy way for markets to behave after a sharp move. They consolidate, build energy, let the moving averages catch up, and shake out impatient traders before the next real leg. In this scenario, patience is the name of the game. Nothing gets decided quickly, and the winners are those who don't get chopped up trying to trade every wiggle. Scenario 3, the failed bounce and retest. In this scenario, the bearish forces reassert. Maybe the ETF inflow turns out to be a one-off and flows flip negative again, the Fed stays aggressively hawkish, the Clarity Act stalls or disappoints, and the short squeeze fuel exhausts itself. Bitcoin then rolls back over and retests the 62,000 region and the 200-week moving average once more. But here's the key: even in this scenario, as long as that major support holds on the retest, the broader bullish structure stays intact. Retests of a defended level are common and often healthy. The bullish thesis would only truly be invalidated by a sustained, decisive weekly close well below the mid-50,000s. Short of that, even a retest could simply be the market building a stronger base before the next move higher. So which scenario plays out? Nobody knows for certain, and anyone who claims certainty is either lying to you or to themselves. But now you have a framework. You know the levels. You know the catalysts. You know what the smart money did, and you know exactly which signals to watch to tell which scenario is unfolding in real time. Let me leave you with a practical checklist, the exact things I'd be watching over the coming days and weeks to stay ahead of this market. Number 1, watch the ETF flows above all else this week. Do the inflows continue, or was that $1.3 billion day a one-off? Sustained inflows would be the single most bullish confirmation. Number 2, watch whether Bitcoin holds above the 63 to 64,000 support. Holding it keeps the reversal alive. Number 3, watch the 66,000 resistance. Reclaiming it on a strong close confirms momentum has genuinely shifted to the bulls. Number 4, watch the Clarity Act's progress through the Senate. Favorable movement is a powerful tailwind. A stall is a headwind. Number 5, watch the whale wallets and exchange balances. As long as whales keep accumulating and exchange balances keep falling, the strong hands thesis stays intact. Number 6, watch the Fed narrative. Any shift from hawkish toward dovish, any hint of rate cuts or cooler inflation would be rocket fuel. And number 7, watch the Fear and Greed Index. As it climbs out of fear, that's often when recoveries gain real durable traction. Here's the bottom line, and I want you to really sit with this because it's the whole lesson of the last few days compressed into one idea. The headlines told you Bitcoin was breaking down, the Fed was the enemy, institutions were fleeing through the ETFs, and the top was in. That was the surface. And the surface is designed to make you emotional, to make you panic and capitulate at exactly the wrong moment. But underneath that surface, the data told a completely different story. The largest, most sophisticated players were quietly accumulating while the crowd was terrified. Coins were moving from weak hands to strong hands. Leverage was being flushed. Sentiment was washed out. The most important long-term floor was being tested and defended. And then the flows flipped. The price reclaimed 65,000, and the market rewarded the patient while punishing the panicked, exactly as it has done over and over throughout Bitcoin's entire history. That doesn't guarantee what comes next, but it should teach you something permanent about how this market works and about which side of these moments you want to be standing on. If this breakdown helped you understand what actually happened beneath the noise, do me a favor and smash that like button, because it genuinely helps this channel reach more people who need to hear the real story instead of the fear-driven headlines that got so many people to sell the exact bottom. Subscribe and turn on notifications, because in a market that moves this fast, being a single day late can be the difference between opportunity and regret. And I'll be tracking every one of these signals, especially those ETF flows and the Clarity Act, for you as it develops. Drop a comment and let me know. Did you buy the dip? Did you sell into the fear? Or did you sit on your hands and watch? And tell me which scenario you think plays out from here, the bullish continuation, the chop, or the failed bounce and retest. I read the comments, and I genuinely want to know where your head is at. And remember, and I cannot stress this enough, nothing in this video is financial advice. I'm not your financial advisor. This is analysis and education based on the data available right now, and this market can and will do things nobody expects. Never invest more than you can afford to lose. Never use leverage you don't fully understand. The liquidation cascade a couple of days ago is a perfect, painful reminder of exactly why. Always do your own research, manage your risk, protect your capital, and think in terms of years, not days. Because the people who actually win in Bitcoin aren't the ones who make the flashiest single trade. They're the ones still standing after the volatility has shaken everyone else out. Stay sharp, stay patient, stay disciplined, and I'll see you in the next one.